So, on the one hand, steady health is the word being used, but got to be careful.
Yeah, absolutely. You know, there's, as you say, it's a complex topic, and I think it's, you know, in the one breath, it's a mistake to analyse South Africa's consumer credit as one big globular lump. You know, there's various sub-components of that market that we need to understand. There's clearly the unsecured space that has been growing rapidly. And I think if we dig into the numbers, we're seeing overall credit health remaining steady. But once we, you know, dig into a bit more granularity, we see that there are some concerns starting to come through in that unsecured space.
So isn't there a danger that one averages things out and you say, well, the average is okay, but there may be a major sector that could cause a lot of problems to the broader system if things go wrong?
I think there are. Look, I think the banks are savvy to that as well. They understand their niche markets and they understand how their markets are segmented. You know, so and we must also remember that in unsecured lending, banks price those loans differently. They price them for higher risk. They price them for higher default. What we're really concerned about going forward would be a rate of default that's beyond the expectations of the bank, something that they haven't factored in. Now, at this stage, there's no particular sign that says that's going to be the case. Of
course, banks have not had a very good track record over the last decade of pricing in failures.
Sure, and I think the where the risk comes in is that banks are under a lot of pressure to write new business. As loans are paid down, banks have to write new loans, and you know, we live in a world where you know, bank loans essentially become the broad money supply, and if loans are contracting, money supply contracting, you go into these kind of deflationary depressions.
But again, it's a pressure for market share, and I recall asking one of the bankers in the mid-2000s, you know, what's more important to you, not to write bad loans or to get market share? He said at the moment we're being rewarded for market share, and of course that leads to one. But now, this is quite a complex measure where it comes from. It talks about repayment, revolving facilities, and so on.
Yes, so the index is constructed using various data sources. The primary data component is derived off TransUnion's tremendous database, which tracks 18 million credit active consumers in South Africa. So it's a wonderfully representative sample, and it's from that sample that we pull things like credit impairments, which is how well are people actually paying off their loans, how well are they paying the interest on their debt.
Household cash flows is another very interesting. So
household cash flows is a macro aggregate variable derived using Reserve Bank data, using Stats SA data. And then, of course, finally is household debt servicing costs, which is derived from the Reserve Bank as well. So we've put those together to structure this index, the TransUnion component being the major component of the index.
Now, there does seem a bit of a contradiction. It's a decline from 54.4 in this index to 50. Like many of these indexes, below 50 is bad.
Yeah.
But the MD, Jeff Miller, says don't overreact to one quarter.
Yeah, and I think that's true of most economic data. You know, having said that, it is at a stage now where I think the index is at risk of dropping below 50 in the coming quarters. What does that mean? That means that we would be moving into a situation where consumer credit health is starting to deteriorate marginally. What does that mean? Well, that means that households' ability to service their debts out of their monthly budgets is starting to come under more strain. And it's at that point, and I think we're at this point now, where banks need to start thinking a bit more cautiously as to how they're extending credit to consumers.
We also talked earlier about the rand and the weakening rand, and rand weakness. This is one of those areas where rand weaknesses indirectly affects consumers. One wonders also if the banks price in everything. So if you had the oil price going the wrong way, the rand going the wrong way, inflation going the wrong way for consumers, things can happen very quickly.
No, they can, and you know, we've long held at ETM that a weak rand is generally for the consumption side of this economy a negative development. It raises prices. You know, essentially the value of the currency is depreciating against, not only against other currencies, but more and more against goods and services, which is called inflation. And high inflation eats into household budgets, and so that is definitely something to watch out for. And I think, you know, if we look forward to 2012, the Reserve Bank has spoken of a relatively benign inflation outlook. We're a bit more bullish on the inflation outlook. We think that there's a bit more upside later on in the year.
You mean it's going to come down?
No. So what we mean is that we think inflation is going to tick up, and we think that there's, you know, a bit more froth in the inflation number towards the end of this year. If we see that coupled with, you know, rising costs of oil and so on, I think that households are going to start to come under pressure. That doesn't mean catastrophe. What it does mean, though, again, just to reiterate the point, is that credit providers, lenders, are going to need to think a lot more cautiously about the kind of environment we're going into in the next 6 months.
Is there a sign that the banks are doing this?
You know, there are some signs, and as I say, banks do price these loans relative to their risk, and they factor in and they budget accordingly. However, at this stage, if we look at consumer lending, it's running along at a pretty rapid click, and so I would say that we're at a point now where banks are quite gung-ho for sourcing new loans and creating new credit. And as I say, if that continues in the same vein, I think we potentially run into some unsustainable territory.
Word of warning there. That was Russell Lamberti, economist at ETM Analytics.